is Invisible Inc., the podcast for under-resourced women entrepreneurs. And I'm your host, Shubha Chakrabarti, founder of Achieve. Join me as I talk to women entrepreneurs about the nuts and bolts of their journeys and to experts who will give you insights that are hard to find anywhere else. Let's jump in. What do investors look for during fundraising due diligence? What one critical fact do most founders miss when thinking about what drives their investors' funding decisions? What's the single biggest mental pivot you need to make as a founder to successfully fundraise? In this episode, Lisa Frusztajer, investor in residence at the Capital Network, talks about what founders should prepare for pre-investment, what factors external to your startup could play an outsized role in the funding decision, the one fundraising skill non-financial founders must master, and much more. Now, here's Lisa. Hey, Lisa, welcome to Invisible Inc. We're so excited to have you here.
Thank you. I'm thrilled to be here.
So you had a pretty interesting journey to where you are today. So what got you involved in the startup world to begin with, and how did you end up where you are today?
I was always really interested in technology. And when I started, I equated startups with technology. I spent most of my career working in technology, and I love the innovation and learning new things. I just find it really intellectually interesting. So I jumped right in and got to work with a lot of small companies that are doing cutting edge things, a lot of creativity. And the most exciting thing is getting to work with founders who get up every day to create something new.
I was looking at your profile and there were just so many touch points where you have interactions with founders. Clearly, the Capital Network is one. We had a fantastic conversation with Marie the other day. So what are the biggest interfaces that you have with founders today, and which are the ones that you find most insightful?
The way that I work with founders has really been as an investor, and I've done a ton of due diligence. I have a finance background. I've done a lot of analysis. As I said, I'm really interested in the technology. And so I have done a lot of due diligence on companies as a lead investor on a fund, and then as an investor on my own. And what I'm looking for is what drives the business, what are the key levers for the business, the extent to which the founder understands that, and then the extent to which the founder has really experimented with what's working and what's not working. Because you know that in a startup, it's not always going to be a smooth path. It's not always going to go right. So to have kind of the outlook that you're going to be aware of the results you're producing and be willing to learn from those, absorb the data, and then adapt is one of the things that I look for in due diligence. And by the way, I love to take a very open approach when I'm doing due diligence with founders. I want to communicate exactly what I'm looking at and why. And I'm also really committed to not burdening the founder with creating a lot of new stuff for due diligence. So it's the start of the investor and company journey, and I believe it should be a two-way street. The other thing that I do is a lot more to do with the founder journey. And by that, I mean the personal journey. Because when you're starting a company, you're really going through a personal transformation as you're creating the company. And when we go through personal transformations, it's not always easy. It's like an analogy is going to the gym. If you're building muscle, it's not going to be easy every day. And in fact, you're not going to do a good job building muscle unless you lift more than you think you can, unless you leave kind of sore a lot of the time. So I work with founders as a mentor. I designed a mentoring program for a great organization in Boston called the Capital Network. And then I'm also a certified coach. So I work as a coach with founders who are finding themselves reaching points where they're struggling with the journey, where they just need some extra support to keep going. So it's as much about the analysis as it is about the personal journey and giving personal support to founders.
I love the juxtaposition of coming at it from almost like the two opposite ends. One is completely private and one is almost completely public or scrutinized, if you will. What triggered your decision to become an investor in the first place?
It was really fascination with what was going on in innovation. And people who are starting new things, it's just a very, very exciting journey. You have to look at things with a fresh set of eyes. So you're learning something new every single day. And I just find that to be a lot of fun.
Great. And I want to dive in on one thing that you said a little earlier in terms of the due diligence process. I really appreciated your concern for keeping it light on the founder and not being unduly onerous. Can you just give a high-level walkthrough of what that typically looks like when you're a lead on the due diligence? Like, what does that journey look like so that if I'm a woman founder going in, looking for investment, what should I expect in the initial pitch? You mentioned the 4 or 5 things which you look for during your due diligence process. Can you just give a quick walkthrough of what that looks like from the moment you hear the first pitch till the moment you make a decision, either yes or no?
There are a few different categories that I look for, and you can find a due diligence checklists online. There are typical areas. You evaluate the team, you evaluate the market and its potential, you evaluate the extent to which the company has traction, you evaluate the technology, and then you evaluate the strength of a given deal as an investment. So in other words, what is the valuation? What is the stage? How does it fit into the portfolio that the investor is constructing? What are the terms? All of that kind of thing. So those are kind of the basic categories. And when you look at those checklists, though, it's basically a document list. And so my approach has been to be very transparent about the different areas I'm going to look at, and then really emphasize to the founder, don't create anything new. We'll do a first round based on what you have in hand and start discussing it. And it's things like looking at the financial model. I'd say that that's sort of under the category of the company itself and its traction. And then figuring out what is the potential of the company to perform. But I think it's really important for the founder not to overlook the fact that an investor is putting together a portfolio. So the investor is going to be looking at the extent to which this company fits into or doesn't fit into the portfolio.
Coming on the other side, you're the founder. You don't necessarily have transparency or visibility into how the rest of the portfolio is made up, and therefore how well you are or are not going to fit in. So what are the things that at a high level a founder can do to maximize her chances, or at least be realistic about her chances going in?
That is such a great question, Shubha. And I really wish that we spent more time really talking about that. Because at the end of the day, you come to an investor, you start a company, you love your product, you're doing something really cool and innovative. But if you're looking for outside capital, the numbers have to work for the investor. Okay, so what does that mean? It means I'm putting together a portfolio. Let's say as an investor, we'll have various expectations for return. And it makes a difference whether I'm investing for myself, where if I love the founder and what they're doing is something that I feel personally is really important, I might have a given return expectation. If I'm investing on behalf of a fund, then I'm accountable to the people who have put up their money to create the fund. So I've made a commitment that I'm going to screen investments to provide a return for the limited partners who have invested in the fund. So my hurdle for feeling comfortable allocating somebody else's capital is going to be very different. Likely it's going to be higher than if I'm investing for myself. So your question on how do people find that out, there's not a lot of transparency. You just have to ask. And I think when you're going out to start a company, the emphasis very often is on building the company. But in order to get outside capital, in order to be successful doing it, you really need to learn the language of the investor. The best way to do that is just talk to investors. If you're getting no's, find out why. And I think we have this idea, like when you look at a typical pitch, a lot of the emphasis is on the product and the company. It certainly has to be on the problem to be solved and market size and all that kind of thing. But at the end of the day, is this going to be a good investment? And I'll tell you a couple of interesting things that I've seen recently, which is that I know 2 women who are out there raising capital. The companies, great product, both first-time founders, but both of them came from private equity backgrounds. So the things that they emphasized in their pitches were not so much the product. They went immediately to how do the numbers work? What's the math here? What is the equation here? And what did that mean? That means talking about what is my path to cash flow break even? Look at my revenue and the growth rate. It's on an upswing. I've got really strong traction and it's translated into a really strong growth rate. These people both had a very deep understanding of the economics of the company. Because one thing I see is, actually, I'm going to just make a side comment here. I've talked to many women who say, I'm uncomfortable with the financials. Oh, I'm not good with the numbers. That's not going to fly. You have to know your numbers cold. I don't think it's any accident. These women from financial services had this very deep understanding of their company economics, the levers that were going to drive the business. They knew how to do a sensitivity analysis, and they were very, very fluent in translating the questions that they were getting in their pitches to how it affected the company results. And I mean financial results. And then the other thing is that they were really able to send signals that touched on investor hot buttons. So in other words, generating a lot of momentum for the round. It's oversubscribed, but I'll let you in. I've generated a lot of early revenue without a lot of marketing. My margins are X% today, and I project that by the end of the year, they're going to be 2X or, whatever. So it's really talking in the numbers, because that is important to know when you're talking to investors.
That is so fantastic. And I'm so glad that you're diving deep into this, because this is what I think women don't get a chance to hear as much. And I'm just thrilled that you're doing this. So a couple of questions on that. First off, not everybody is fortunate to be in financial services, and you may not have had the luxury of living in that world and learning the lingo, so to speak. What are some methods that you've seen work or that you would recommend that somebody get a crash course or get really familiar really fast? Because it's something, as you yourself mentioned, instills fear, needlessly so, but it still instills fear. What do you recommend they do to get up to speed quickly on these terms and these lenses through which they should learn to look at their startup like an investor would?
Yeah. Part of it is talking to investors. A big part of it is talking to other founders who have been successful in raising money and understanding what the end game was for the people who succeeded. That'll help you learn the language. You still need to figure out what the journey is for you. And a part of it, like with anything you've never done before, is just dig in. Do your financial model. Do your financial model yourself. And too often, I've had people send me to the fractional CFO during due diligence because they don't want to talk about the financial model. When you look at it, it's basic arithmetic. And so we're not talking about high-level math here. What we are talking about is how to translate the numbers into a story. So pressure test your model, just get in there and work with a model. And guess what? It's really important to do it because your investor is going to do that. And a couple of times I do that. I asked for the financial model. Part of it is I love doing the financial analysis. I think it's fun to do this kind of thing. But you also want to see where the potential is for the company. And a couple of times I've gotten financial models where they don't work. So things are double counted. And it takes a long time to put together a really good, robust financial model. There are a lot of resources for getting good ones. There's actually an excellent one that is put together by the Boston University Accelerator. And if anybody wants a link to that, please email me because it's very, very good. And it generates really, really good management statistics. So the only way to learn how to do something you don't know how to do is to do it. There's one other thing I'll say, though, which is to listen to the feedback that you're getting. Because, your original question, Shubha, is how do you learn to speak investor talk? Really listen to the feedback that you're getting and make sure that you understand it. And I'll give you an example on that. So about a month ago, somebody approached me, great entrepreneur, has made great progress, and she's doing a diagnostic test kit. So she asked about looking for investors. So she doesn't have a prototype. she's got a good 6 to 12 months of research before she hits a prototype. So I asked her, well, have you considered non-dilutive funding? And the response back was, yeah, but it takes 6 months to get the money. And I just thought that was an interesting response. So she's not investment ready. And I was far from the first person suggesting she get non-dilutive funding, but she continues to ask for investor money. She needs to understand why she keeps getting that same answer. Go after non-dilutive funding. It's because she's not in a position to really paint a picture where she can portray the way she's going to generate a return for the investor.
So I'm going to ask you two follow-up questions on that amazing explanation you gave me. The first is, you said you looked at the model and you'd encourage all founders to kind of dig in and see if it doesn't work. And you said this model didn't work. Now, there are two levels at which a model won't work, right? One is, as you mentioned, is the plain math doesn't add up. Some formula is not right. Something's double counted, something's not counted at all. There's also a second level, which is the results that you're expecting or projecting to come from the inputs, that relationship doesn't stack up. And I'll give you an example of, I'm expecting sales to grow at 40%, but I'm not seeing the marketing investments. I'm not seeing the hiring of the salespeople. Can you talk a little bit about what types, I don't know what you call them, type A, type B errors, whatever, right?
Yeah.
How much of each do you see? And what counsel or suggestions would you offer to founders to make sure that they make neither of those types of errors?
I'm going to give you my personal perspective on it. I like the differentiation between type A, type B errors. But let's just sort of say math errors and projection errors. The projection error meaning you anticipate something's going to happen, but your assumptions are kind of off. I mean, the math errors is just carelessness. You've got to really go through and test your model, have other people look at it and know it. So I suppose that's sort of an easy one to look at. So yeah, you just need to make sure that your model is clean and working right. On the second kind of error, projection error, when you're working with a really early stage company, let's face it, you don't know what's going to happen. So what I look for in that kind of a thing is transparency of assumptions and being able to trace the assumptions that the founder has made on, let's say, salaries or expenses or how they're going to tie capital coming in or revenue being generated to expenses. So, what's strong, what's not strong, it really is so situational. It's very hard to generalize. So, for example, if you look at a company, even if they're investing a lot and they don't become profitable quickly, that investment may well be worthwhile because it poises them for future growth. So there's not any one standard that you would apply, but I love it. It's just such a joy to work with founders who document their assumptions and are ready to discuss those assumptions. So here we are again to this sort of duality. There are the numbers, and then there's this sort of human side of it. If you're a founder and you've got an appetite for somebody poking at and pushing at your assumptions, and you respond with really an eagerness to get into the discussion and to take in another point of view. I mean, that's a really strong way to present yourself and to present your company. It shows that you've thought about it. It shows that you are ready to take in information. Some people call that coachability. And it also shows that you have an understanding of what's driving the business.
And my second question back to that is, you had mentioned earlier that it's important for the founder to be able to listen to the feedback that you're getting from any potential funder. Now, one thing I've heard, and I can see why a funder or potential funder doesn't have any incentive to give you the real feedback. So they have nothing to gain and everything to lose if they give honest feedback. So my question is, how do you know what feedback is real and what's just a polite no? And then secondly, what can you do to increase your odds that you're going to get real feedback?
So let me just ask you, what do you think is the reason that there's little incentive to give real feedback?
Well, one is founder-driven and one is funder-driven. The founder-driven is, I have no basis to know how you're going to react. And I think to be very candid, the dynamics get convoluted if there's a gender and a race difference, because who knows, right? It's if I'm a white male, You think I'm going to take a risk? If I were a white male, I certainly wouldn't, right? That's the founder side. And then the funder side, let's say I say that your business model isn't going to go anywhere. And then tomorrow you turn out to be the next Uber. I'm not going to lose out on a chance to participate, because what are the chances you'll come back to me if I said no? I'm never going to be able to participate in future upside. So I think those are the two drivers, but I could be wrong. I'd love to hear what you have to say on that.
Yeah, I think those are really interesting comments. One thing I would say is that part of the culture of the investment world is everybody wants to keep the conversation going. And sometimes that's to the detriment of the founder. And you're right, there is a power dynamic that is inherent in the investor-founder relationship. So the investor has the money and can decide whether they want to put it into the company or not. And then the founder is the one who's out there making the ask. So I think there are a couple of things. One, I think it's really important, and this takes a lot of internal work, to turn that dynamic into something where the power imbalance is lessened. That's where, to a large degree, coaching comes in, which is to have that belief that you actually are doing something that is valuable and that you have the ability to design your investor. There's no shortage of capital out there, but we have this idea that you make a pitch and somebody gives you a check. Is that the way it needs to work necessarily for everybody? Why not just have a series of conversations, build relationships as a founder, and then be able to decide what is the best path for you? That's one thing I would say. The other thing is, when you have that relationship, then you really can have a much more candid conversation about what's really going on. Because let's face it, the investor doesn't succeed unless the company succeeds. So if you're the founder, asking questions about what the investor's goals are, I think is really important. You also have to remember, though, that investors are likely getting dozens of these inquiries all the time. And they may be just polite or doing a favor by talking to you. But I think this is really the fundamental point here, which is within this industry where there is the potential power imbalance, I really think that it is the founder's job to define what the conversation is about. So, for example, if you're a founder, you can go out and have all these conversations, but you don't know necessarily, unless you define the conversation, whether the end game is making an ask or is potentially getting money, or is this just get to know you kind of mentoring conversation? And you can really burn a lot of your time. I think, and this is part of what we've really instilled in founders through the mentoring program that we did at TCN, it's a leadership opportunity for the founder to be the one to make the ask and to define what the conversation is all about.
Got it. And kind of wearing your shoes of an investor for a moment, are there things that signal to you that the founder is potentially coachable or at least open to receiving feedback that might make you more predisposed to giving them your actual thoughts about the problems with their business model or their pitch? Or is that something that you just stay clear of? I'm just curious.
Yeah, unfortunately, it's subjective because everybody's idea of coachability is a little bit different. It's getting to know people and it's getting comfortable with them. And it's just having the conversation and digging into things.
Got it. You had mentioned that this mental transformation that you need to make is really important, building that muscle. Have you seen any pivotal moments or tips or things that through your personal coaching work that have helped founders make that flip in their mind to say, I am now more comfortable doing that? Or is it just a matter of keep doing it over and over again until it becomes embedded in your muscle memory, so to speak?
You mean where the founder really is the one who's ready to take the reins?
Yeah, it's that whole, you have to make that mental transformation. You have to be willing to ask.
Yeah, I think the answer to the question really hinges on how do you come into your own? How do you get to the point where you feel confident? And it's really, how do you get to the point where you have a sense of self-confidence? And the only way to do that is to keep doing the hard things and test yourself and also acknowledge that it's okay if it doesn't feel easy. If you're doing something new, it's going to be difficult. And you have to just bring that anxiety or that fear or that discomfort along with you. I don't think there's such an easy answer. Now, I will say that if you've never raised money before, when you get your lead, when you're successful raising your first round, that can make a tremendous difference because suddenly you feel like you've got other people on your team.
I love the example you gave earlier about how you had counseled this first-time founder that she needed to look for non-dilutive sources of money, which brings us to the question of, there's a variety of early-stage funding options. So what are these, pragmatically speaking, for women and especially diverse women founders? And how should a first-time founder be thinking about these options? In other words, how should she build her capital stack?
So I'd say it's really a combination of looking at what is in your interest, what the options are, and how your company is going to play. So understanding return expectations is really important. So a few things that are in your interest. You have to understand with each source of funding what you get and what you give up. And when I'm talking about each source of funding, I mean, it could be loans, it could be crowdfunding, it could be revenue-based financing, it could be non-dilutive funding, or it could be investor money, which also takes many forms, from equity to debt, et cetera. And there are companies that have used 4 different forms of financing over the course of their first couple of rounds. So there's no right or wrong. But the answer to your question on what should people seek, I see that primary founder interests is falling into a few categories. One is the amount of equity that you want to hold. So, if you do revenue-based financing, then you're going to hold more equity. If you do debt, you're going to hold more equity. And women give up way more equity than men do historically. So that is a real gotcha. And women of color give up way more equity, even more equity on average than white women do.
I mean, that is unfortunate but unsurprising. So I think some of the dynamics from a founder perspective, at least to me, are more understandable because you kind of go to the table a little more scared, a little more apprehensive, and expecting a little less. Are there dynamics on the other side of the table that are also driving this trend or this phenomenon?
Oh, you mean investors who are going to drive a harder bargain or ask for more?
Exactly.
Well, I think we wouldn't see the macro statistics we do if it weren't happening from the investor side of the table. My own personal experience, though, has actually been very different. And that's part of why, you were asking about my investor journey. I said I started out really looking at tech, but when I realized how egregiously inequitable the funding environment is, I really switched. So my portfolio now has a much broader range of companies, not just tech. And most of the people who I invest with are female. But you're asking about the dynamic from the investor side of the table. I have seen investors really encourage and support founders to negotiate harder, to not give up so much equity, or investor attorneys who really understand the nuances of the agreement and will point those out and then ask founders to renegotiate. So my own personal experience has actually been really, really positive. But if you look at the amount of technical knowledge that requires, because the terminology, I mean, I have to refresh my memory on this terminology all the time. I find it really confusing. It's hard to remember. And guess what? It's always changing. So you do need an advocate. I've been really fortunate in seeing advocates more often than people who are oppositional. But back to kind of what are the founder interests, the things that you have to have in mind. You don't really learn these until you are out there raising capital. But I'd say that the primary one is equity. You want to maintain control over your company. You want to maintain ownership. You're doing the work. You're generating the value. As the founder or the founding team, you should hold on to equity. The other thing is you want to have supportive investor relationships. So, when you're doing a deal, you need to think about what is going to be demanded of you in making the investment, going through due diligence, and then dealing with the investors after the fact. You want to have a reasonable cost of funds on balance. And then you also want the investment to really meet the needs of the capital needs of your company. The other thing is when you're looking for investments, another big founder interest is what it's going to take to get your company to the next level. And you get just to decide what next level is. I mean, maybe you want to have like a nice sort of steady growth rate company that you run in perpetuity. Or maybe you want to have 60% revenue growth every year. Those are very different definitions of success. And the investment that you take has to match those. So just to bucket kind of what are the founder interests, it's equity and control. It's having a manageable approval process, supportive investor relations, optimal capital flow to match the needs of your business, and then skills and context to grow the company. And each of the sources of capital that we talked about has those in different measures.
So it almost feels like you want the founder to be creating a matrix, so to speak, to say, here's all the things I want, and here's the different sources of financing. And then let me do an objective evaluation or assessment that says, where do I stack? Or where do each of these stack up so that I can make the right call to say, okay, I'll go after this, but this is incompatible with what I see as success for my startup.
Yes. And then there's another important thing that we haven't really touched on, which is what are the expectations? So I'm the one who's giving the capital. What are my expectations in return? And am I the kind of company that can or wants to meet those expectations?
So there's clearly a return expectation, which is embodied in the form of the milestones that you're committing to, revenue, whatever the case might be. So there's financial expectations. What are the other expectations that founders should be aware that investors would have, and how would they ferret them out during this fundraising process?
Yeah, the financial expectations or the return expectations are a really big one. And even within different asset classes or forms of funding, there's going to be great variability. I mean, a giant institutional, huge venture capital fund is going to have one kind of return expectation, but a small sort of single-digit millions fund, or certainly angel investors, might have very different return expectations. So that's something that's very important to remember. But one of the big ones is what is going to be the ongoing relationship with the investor? What are the reporting requirements? What are the board seat requirements and board of advisors requirements? What am I going to have to do to remain accountable? And what is the investor expectation of me? So if you get a grant, then yes, you have reporting requirements, which are no small task, but you're unlikely to have somebody calling you up every X number of weeks to find out how things are going. So managing that, I think, is really important.
So then all of this brings us to the question of what the founder is facing as she's kind of setting out into fundraising of whatever form in the early stages. What are you seeing as the current trends, or what can she expect going into the fundraising scene as an early stage diverse woman entrepreneur today?
We like to look at the kind of depressing statistics on percentage of venture capital dollars going to women. I am sure you've seen this, but the earliest or the latest data from 2022 says that things got even worse in terms of percentage of venture capital dollars going to women. And that is a reality. But whether it's 1.9% or 2.3%, it's pretty bad. However, what I'm seeing just over the last few years, I don't know if you've seen this, Shubha, but it's kind of incredible. There's been a much higher level of awareness of how inequitable the system is. So I'm seeing really a broadening of the types of ways that companies are getting funded. And it's not easy to get capital, the very, very network-driven industry. So the hard reality is you do have to do the work and find people and go out and make the asks and build the relationships and build the network. But I'm also seeing more investors jumping in. And I think it's broadening the option. So I'm actually very encouraged. I think there's capital out there. It may not be in the form of what you see on TV when you watch Shark Tank, but I'm seeing a lot of women in particular who are successful getting money. The other thing is that the industry, and by the industry, I mean the industry of investors and of founders, continues to expand. So there are more opportunities for people to participate in accelerators and fellowships. Corporate venture is also growing. So there are more ways to do it than just the one size fits all. Yeah, I'm going to guarantee a 10x return and hold just a tiny percentage of equity of my company.
So that leads me to a question that you briefly alluded to earlier in one of your comments. You said that time is limited, right? And it's going to always be a multiple of the time and effort for you as a diverse woman entrepreneur or founder to get to the same level of access or resourcing as maybe a comparable white male. How do I, as a founder, maximize my ROI, knowing that I have to do this so that I shorten the duration or in some measure, I improve that outlook of ROI to get any resources, whether it's funding or mentorship or frankly, even good employees? What have you seen work?
There's a founder who's based in the Boston area, and she was a speaker actually at a TCN event. And she sent out cold emails asking people to talk to her about funding her company. She got a 90% response rate on those cold emails, which is amazing. Okay, so why? I mean, that is really a great example of shortening the timeline of getting a response. Now, did all of those responses lead to funding? Of course not. But it's just a perfect example. So if you deconstruct, what did this person do? She went straight to her traction, her revenue growth, where she was headed financially. So it's back to this, speak the language of the audience. And she didn't talk about, she was very crisp on what her product was, but she really went right to the results that she was going to produce for her audience, the audience being investors. So I think that's a beautiful, quantifiable example. Now, do you know that that investor is going to write a check? No. But, the fact is, it does take time. Actually, you were recommending that book, the Yuri Levine book, and he calls fundraising, I love this, the dance of 100 no's. I mean, that's just the reality. You're going to go out, you talk to 100 people, you might get one yes. So you were asking, how do you shorten the timeline? I suppose you can shorten the timeline by doing the same thing you would do if you were selling your product. You understand what your audience values and you really address those interests. But I don't think there's a way to make this really easy. It just takes time.
Got it. And what I'm hearing loud and clear, Lisa, from everything you're saying is you take that same skill set that you've applied in bringing your product to market, you flip it to a different audience and you sell your startup as an investment proposition. Of course, it's a complete change in orientation. You need to learn a whole new set of skills, but you want the money, you got to do the work is kind of what I'm hearing. Is that a fair characterization?
I think that's beautifully said. Your product, when you're talking to investors, when you're looking for capital, investors or even non-dilutive funding, your product is your company. So in other words, your company as a viable investment that is going to generate a return. And what the potential funder is going to be looking at is a little bit different. This is why it's not easy, because when you start your company, you're solving a customer problem, but you have to learn a whole new set of skills. You're really changing your identity. And this is why it doesn't happen overnight. And this is why it's very hard to do this.
Got it. And one other quick question on that, and we'll move on to a few other things. You mentioned this issue that you have to go out and meet people. What I've read about the whole investment industry, at least parts of the VC or the risk capital industry, is that it's a game of pattern matching, right? And it's very easy to drop to the lowest common denominator, which is how you look, how you speak, where you went to school. Now, there are a lot of things I cannot change about myself. I can't change how I look. I cannot change the color of my skin or my accent for that matter. How prevalent is this, first of all? And what can you as a woman founder, and especially a diverse woman founder, do to minimize its negative impact on your prospects?
That's a great question. So this is one of the big things that I coach on. And I refer to it as executive presence, because executive presence really translates into what's the snap judgment people are making about me. And people use the term executive presence because it seems a lot less threatening. It's like a nice, plain vanilla term of who knows what it means. And it really is exactly, how do you come across? Do you command the room? How do you look? How do you hold yourself? And it's based on judgments, all those things, including your age and your background, your skin color, et cetera, et cetera. There's nothing that says, there's no law that says that the way you raise capital has to be by standing in front of a room, making your 7-minute, very rushed pitch, and then being pelted by aggressive questions. We have this archetype that that's how fundraising works, but there's no law that says that it has to work that way. And as an investor, when you watch enough of these pitches, they're so well rehearsed that sometimes it's actually hard to understand what somebody is saying. And then there's the time pressure. So my answer to your question, how do you overcome snap judgments or bias? And it's by working to build a relationship with people and making the process less performative and more interactive.
Which is telling me that it's more of a thoughtful, strategic, one-on-one, done over time kind of relationship building versus going with a bang at a demo day or something similar, or pitch competition and trying to win over the world, which I'm guessing isn't going to be such a high ROI proposition anyway going in for people like us.
Yeah, it's not that it's bad practice. It's probably good practice. And why not go into it and say, all right, this is going to be challenging, but I'm going to learn a new set of skills and I'm going to make it fun. But I'll tell you, there's another piece of it, and that is really allowing yourself to discuss maybe the things that didn't go quite right. This is really tied very closely to developing confidence. Because if you as a founder, so I recently invested in a company and the founder had gone through a bunch of ups and downs. Not everything had worked out great, but she was so clearly persistent and resilient and thoughtful and taking in the data. So I think that there's a piece here where we feel like we have to have these polished, perfect presentations that is everything is going great, but everything doesn't always go great. So when you can develop a relationship with somebody and really discuss the things that maybe were a little bit challenging and how you dealt with those, I think that's really, really important. That engenders a tremendous amount of trust, but it also requires confidence on the part of the founder because it feels vulnerable if you're talking about things that don't go wrong. And I don't think that that kind of conversation is really all that easy to have when you're in front of an audience giving a 7-minute pitch. Not to say that it can't happen, but it's generally getting to know somebody over time.
So which brings us to this question of the whole investment side or the supply side of capital. What are the things you're seeing? Earlier, I was just so happy to hear that you were noticing all of these encouraging trends, tailwinds that are working towards funding more women. What are the other trends you're seeing that still give you pause and that cause you concern that may prove to be headwinds that women need to be aware of?
I'd say one thing, which is that the macro statistics are still very real. I would love to see more capital flowing to women, but I would also really love to see an acknowledgement that there are a lot of definitions of success. And I feel like we still don't quite have the language to work through some of the problems of bias, some of the problems of pattern matching. And that is a two-sided conversation. I'm convinced everybody wants to do the right thing. I mean, I'm an optimist. I think people want to see more equitable distribution of capital, but I really don't think these are touchy topics, and it's human nature. We avoid the touchy topics, but I think we have a lot of room for improvement on addressing these head on. And so, for example, when we designed the mentorship program at TCN, we really focused on DEI training for anybody who wanted to become a new mentor. And there were a couple of interactions that were less than optimal, and we addressed those immediately. But I think we could get a lot better at that.
So basically what I'm hearing is there's a long way to go, but all you can do right now is you got to keep taking each step forward so that over time, the impacts add up.
Yeah, I think so. And so why do we have a long way to go? I think one of the reasons we have a long way to go is because we still have people who are underrepresented as founders, as investors, as decision makers and institutional investments, it's still a small percentage. So maybe it's no surprise that we haven't gotten good enough at having those conversations where the imbalances are and what some of the remedies are.
So that brings me to another question. I think it's very obvious based on the numbers that the majority of decision makers in the world of capital are still men, and probably white men as well. So what role can men play? And I'll tie into this the question of allyship that we hear a lot about. To what extent are allies critical in this? And more importantly, how do you as a woman figure out who a true ally is versus someone who's just saying it because it's like the word du jour that is the right thing to say, and it's a buzzy buzzword to say, oh, I'm all about inclusion and DEI?
Yeah, I think it's a really good question. I think we have to all be willing to have some awkward conversations. I mean, the other thing is that actions speak louder than words. And I do know several white male investors who are really committed to backing women and are really there for them and mentoring them. But I still get questions like, I had somebody send me a pitch and I gave feedback, and the person didn't respond to any of my feedback and said, well, I just wanted the women's point of view. And I was really taken aback by that. So it was actually a healthcare company. And what does that even mean? What's the women's point of view? So I talked to the person. I'm not sure it really changed anything. Or I get a lot of people saying, oh, I really want to find female engineers because, we all know that the pipeline into STEM professions, it starts with a lot of women wanting to go into STEM, but then there's a big drop off. And if you're an all male company, bringing one woman in is not really going to be an optimal work environment, but it's also not likely to provide optimal results. So if you've assembled your team, it's all male, you don't just bring one woman in to kind of solve that problem. I think you have to look at the symptoms. So this is part of a bigger conversation. What do we do? Because it's a lot of things, but I think we just have to, as I said, be willing to have the awkward conversations, because I think they're really going to continue. I think we also have to be really open about these strange interactions that happen. There's still, I think, a reluctance to call people out just because, I don't know, we tend to want to be polite.
And the stakes are too high for women, right? Like, you call someone out, you probably risk not getting capital from a lot of other people who you didn't call out as well. So I think
it's the gender double bind. The gender double bind is if you stick up for yourself, then you're seen as non-feminine. If you don't stick up for yourself, then you kind of crumble. Let me tell you one other story. Somebody asked me, how do you coach women to be really forceful and decisive without being perceived as a
very aggressive person?
The B word. Yeah, there is still that gender double bind. And I just think it's awareness on both sides that we need for that.
Which brings me to a great question I've been wanting to ask, which is, you do a lot of coaching, particularly to women founders. And I think that aspect of that fine line you have to walk between assertiveness and over aggressiveness, for lack of a better word. What are you seeing, and what do you see as transformational practices, moments?
One thing that's really interesting is that a lot of women, probably most women I talk to, get to the point where they really believe in their gut that the price of pursuing the entrepreneurial journey is lower than the price of not doing it. So in other words, you're facing the fork in the road. Do you want to do the easy thing or the easier thing, which is to continue what you're doing right now? Or do you want to embark on this harder thing where it's going to be challenging? You're going to face bias. You're going to face imbalance. You're going to be the lightning rod, or, you're going to be under scrutiny all the time. And virtually every woman who I talk to feels like the price of not trying is higher than the price of trying. So what does that take? It takes a real commitment to doing it because you believe that this is what you were meant to do, that you're really committed to walking this path, and you're willing, this is really important, you're willing to accept a lot of discomfort and just work through it. But at times it's going to be so uncomfortable and anxiety provoking that it's going to be hard to be productive. It's going to be hard to get things done, but you're willing to tolerate that in the service of trying it out.
I think the number one trait that you just laid out is this willingness to stick with discomfort in pursuit of a greater goal. You've seen a lot of women founders, you've looked at a lot of pitches, you've done a lot of due diligence, right? So if you had to paint a composite picture of a really successful woman, what would those traits be in addition to what you just said?
Oh boy. It's so funny because I'm not used to generalizing. And I'd say certainly resilience, but also a lack of fear of being invulnerable. So in other words, really digging into what you're doing and being passionate about and energized by having the conversation about your business. And if you can engage people on that level, then you're really building relationships, you're inspiring your team, and you're testing yourself, but you're doing it because it's something that you really want to do and that you love.
Fantastic. So to wrap up, what are the top pieces of advice you'd give to early stage women and especially diverse women entrepreneurs that they can do Monday morning to improve the chances of having, your point well taken, a successful venture, whatever that means for them?
That's really interesting. As I think about it, I think we've kind of touched on all of them. So the first one is know what's right for you. And that will take some homework and it'll take some experience and it might take some mistakes. So know what's right for you and chart your own path, create your own journey as a founder, create your own journey as somebody who is taking in capital. That's number one. 2, think like an investor. Know what investors are looking for. Learn that language. It's a new language. If you've never done it before, then you're going to have to learn a lot. I mean, particularly if you come from a non-financial background. And then 3, to get to the point where you understand that what you have to offer is valuable to the other person, but also the journey that you're traveling is valuable for yourself is really important. And that takes self-confidence and self-knowledge. So it's sort of back to what we were talking about earlier, where sure, there's an analytical piece of it, but it's really an internal transformation and a very personal journey.
Got it. Thank you. This has been supremely inspiring, informative, educational. Is there any question that I should have asked you, but I didn't?
You are such a good question, asker, Shubha. I love it. And you were so great at picking up on one thing and expanding on it. So really, really appreciate it. I can see why you have so many amazing podcast guests.
Thank you. And you're one of them. So I'm really appreciative of you taking the time, Lisa. This has been it's been a truly amazing conversation. I loved all the pieces that you talked about it. So I want to thank you for your time and your generosity in sharing your insights.
Thank you for everything that you do.
What stood out the most for me in this conversation with Lisa was the calm, objective, yet very supportive perspective she brought to topics that are typically fraught with mystery and maybe even anxiety to many founders. Clearly, there were a lot of nuggets she shared, but here are 3 that stood out for me. 1, in all this talk about pitches and investor introductions, it's easy for founders to forget that for all of this work to pay off, your documents and structure must be in pristine shape to pass due diligence. Don't overlook the boring foundations of getting funded. 2, as a founder, you can become tunnel vision during fundraising and focus solely on your own situation and your own startup. After all, it's your baby, your world, maybe even your universe. But your pitch and startup is typically being considered in the broader context relative to factors completely external to you. The portfolio composition, other startups vying for funding, maybe even stock market performance. Staying objective about the funder's context helps a lot. Last but not least, my favorite point she made was about how critical it is for you as the founder to do a mental flip and think about the product you're selling as the future profits and returns your investors will be eager to buy. Can you master this intricate flip? It can be a game changer. So, what is one thing you will do tomorrow to make your startup more attractive to funders? Thanks for listening to today's episode. We have show notes and more at achieve.co. That's ACHIIV.co acing.com/podcast. Like what you heard? Hit subscribe and share with a friend. See you on the next episode. Now, go be an achiever.